What is up, everybody? It's your average trader here. I am just making a quick video on just some things that I personally am going through, just so you guys can see where I'm going through in my trading journey. So if you've seen in my past videos, I liked to use the EMA strategy that I had found, which was the 13, the 30, and the 48 EMA. And now I've started to transition over to a different strategy that's called supply and demand zones. I'm using that because it seems to be a little more consistent with gains in terms of knowing when to enter and exit. So for this video, I'm going to take you guys through quickly what is a supply and demand zone. What I found, I could have the definition completely wrong, but so I'm just trying to explain it in the best way that I can, because I want you guys to see what goes through my mind, how I'm trading lately, and how I've been seeing more consistent returns with this strategy that I've learned. So basically, what is a demand zone and a supply zone? Essentially, when you see price, what we know as consolidating, meaning it's choppy, or is another term for it, where it's just up and down. This is considered a balance zone where price isn't going up or going down, because buyers and sellers are agreeing on that the price should be around this area. And supply and demand zone, what it basically does is it takes into account how big institutions are the ones that really move price, because us as retail traders, we're so insignificant. We can't really move price that significant on bigger tickers like obviously SPY, Apple, Tesla, things of that nature. And so the way these institutions are trading is they have massive orders that they place, and when there is a balanced market, they are taking into account buying at the top, selling at the bottom of this range. And so when there is an imbalance, price tends gets a sharp move down or a sharp move up. And in that imbalance, these institutions, when they place their orders, and we obviously can't see them because some institutions, or majority I believe, hide their orders so that they're not seeing what they're trying to do. But when this imbalance happens, their orders stay here. And so that is where we call a supply or demand zone, depending on the way it went, right? So in this case right here, I'm looking at coin. I'm on the 4-hour chart. I see price was balanced, and then an imbalance happened. And so what happened there? There were sell orders here that got left behind. And so now this is called a supply zone. And what the thinking is when price comes back in here, they won't get rid of their orders. It'll stay there. And then when price comes back into this supply zone, there's a supply of shares there that when it comes back in, it'll drop, and vice versa. If it's balanced and there's a huge upside push, buy orders will stay there. And so when price comes back down to this demand zone, because there's a demand for shares, that those buy orders will take into effect and push the price back up. So that's what I've been doing. And so mapping them, I turn off extended hours because I want to just make sure what the institutions are trading, which would be during the trading days, nothing really during pre-market. Although you can find some zones in pre-market. So just taking a look, I look for where price is balanced, and then I look for heavy pushes down, so really full candles after a basing candle. And a basing candle means that there was really no direction. There is a upper wick and a upper wick and a lower wick that's relatively the same height between the two, so this one. And then we start to see an aggressive push down, right? So the way you would map the zone would be from the base of the whole candle, not the wick. In this case, since price pushed down, to the very top wick of that candle. So this would constitute as a 4-hour supply zone. And then I move down the chart to the 2-hour. I look for any other movements like that. I don't see any. I move down to the 1-hour. I don't see any kind of aggressive moves. I move down to the 30-minute. And then I have this one mapped here because the price had just recently entered here, and I wanted to add in the extended hours. So that was last night. I had coin on my watch list, and I go all the way down to the 15-minute chart. So yesterday I had mapped 15-minute supply zone, right up here, as you can see, the day before, price came up here, based, and then a massive push down. So I have the supply zone from 53.50 all the way up to 54.25 on the 15-minute chart. And then down here, we saw price came down here. It based in an aggressive push up, and it just kept going up. And this constituted as a demand zone on the 15-minute time frame. So that led me to this morning saying, okay, I like to execute on the 5-minute chart. I saw price came all the way up at 925, was in this supply zone. So I knew right off the bat that because we're in the supply zone, puts might be the way to go because there will be an aggressive push down. And in the morning, I also saw on the 30-minute chart, because I wanted to see if there was anything that happened in pre-market, I saw price coming down. This candle was before this aggressive push, and I figured, you know what, that is a demand zone on the 30-minute chart. And it was great that I had mapped that, because taking puts first thing in the morning and then riding them all the way down into this demand zone, because you know price could reverse, was from 53.50 all the way down to 49.30. So that's pretty much a 4-point move. And let's take a look at a put option. So let's say price opened around 52.54. Let's say you took the $52 put. So price opened up 9:30. Let's take a look at the 9:30. Today is the 14th. So 9:30, right? Let's say you hit this high of $430, and then price hit the demand zone around 9:45. So you would have sold at a peak of around 570. So let's say you hit this high of 430 to 570. That's a $150 move right there on one contract, right? You knew that was going to happen, and boom, you got out of it. Now let's say you wanted to switch then to calls, right? Now at this point, you won't be as aggressive and waiting until the next one, because you know it's intraday. We also know FOMC. You have to also take into account market conditions. So let's say you got into a call around 950 and price was around 49.25. So let's say you got a $50 call. Let's take that into the chart. And I said at 950 you got in. That would be, let's say you got in at the high of 360 and you wanted to lock in gains. You could have kept a stop loss, right? Going up, and you could have gotten all the way up to 478, right? So 360 to 478, that is also another $100 return on one contract. So that's $200 on the day, just taking two solid trades, looking just at this chart. Let's say you get stopped out at this basing candle, right? You saw a basing candle on the 5-minute and you said, you know what, let me just stop out of this, or let me sell it. You could have sold here, waited for price to come right back down again, and that was around, say, 10.25, right? Let's say we're buying right in at the touch of the demand zone, 10.25. Let's do that $50 call once again. Right at the touch of the demand would have put you in at a high of 350, 360, let's say. This contract ran all the way up to $500, which was around this time frame here, right? So let's say you bought in here, you wanted to sell at this level, because I still use levels, right? And essentially with supply and demand zones, the way I look at it now is this is my entry. Anything in between here, I typically average down. Let's say I average down 50% way through the demand zone. And my stop loss would be any kind of close or touch outside of the demand zone, because that means all of the orders got cleared out. So I don't want to be in this play anymore, because now this demand zone is becoming invalid, because all of those buy orders are gone. They've been eaten up. And so you could have bought in at the touch here, and let's say you wanted to sell at this touch of this level, that's 1055. We saw from 1025 to 1055, 1025, high of 360, let's say, and then 1055 would have been a high of pretty much break even, right? You could have gotten 380 before that. it comes back down, or you could have just kept your stop a little bit less than 10%. You could have kept holding, right, and reached the $500 mark. So it's really up to you how you want to do it, right? Here's a $100 move. Here's another $100 move. Here's like, say, like another $30 move or so. But if you kept holding, that would have been a $200 move. If you wanted to hold all the way up to this supply zone up here, that would have been crazy if you could have done that. But that's basically it, how I'm doing it. And this is just one ticker that I had on my watch list. I also had Amazon this morning. Taking a look at that. Amazon, supply zone, 15-minute supply zone, down, straight into demand, sold. You could have switched to calls. Boom, another move, and then back down. You could have switched to calls again. Boom, another move, back down. Calls again, boom. Demand, calls again, boom. And then here, right, you could have gotten in calls. You would see this consolidation. There's no move. And then now look at this, stopped out. Amazon just outside of this demand zone, which makes this demand zone now invalid, in my opinion. I'm no longer going to use this demand zone. Do I have any other ones mapped out? I don't think so. I don't think I have price below $100, but I know $101.40 is a strong level. I'm still using key levels, just like in my last video that I put up yesterday. But this is how I'm using it, right? Typically, if I hit my target on the day, I'm not going to keep trading these intraday's demand inputs or demand drops or supply entries. But this is basically how I'm doing it now. This is just my new perspective on it. I've been testing it out for 2 weeks now. It's been pretty consistent. I've been testing it out on paper, and it works for me. So take it with a grain of salt. There's a lot of good videos out on YouTube. You can start researching the supply and demand, but this has been working for me lately. Like if I take a look at the EMA here, this would have worked for a put, but then look at this. It's saying puts, but price is consolidating, and it actually broke out. I would have been out here, or I would have been out here. So the EMAs are great, but those are called lagging indicators. Supply and demand are leading indicators because you want to see price action. And that I've seen is way more profitable, right? There's nothing wrong with using EMAs and all these other kind of indicators. You can go ahead and use it if it works for you. If you're making money consistently, that's great. But this is something new that I wanted to try out. It's working for me. So if you guys have any questions, let me know. Hit a like, comment down below if you have any questions. I try to answer anyone and everyone. All of my socials are linked in my bio. But again, if you guys have any questions, let me know. Peace.